Hope everyone's doing well. So, lots happened over the past few days. We've had a wedge top on the daily chart. 1, 2, 3, and it's probably been in the trading range since July. These rallies just don't look. This rally here, it's great. The pullbacks are deep. Bears are making money. Deep pullback here. A lot of overlap here, and typically what happens is a trading range is formed after you have a channel. So we rallied, we're channeling up, and eventually channel, usually you get a bear breakout. You see you have a bull channel, you get a bear breakout, and you form a large trading range. Easy way to think through this is here. Big rally, pullback, starting a channel, and quickly form the trading range. And the market's in a bull trend. We know that. It's in a bull trend on the higher time frames. And often when you get these sell-offs, they happen quickly. I mean, if you really think about it, you can argue since the 4th of January, we've gone from 4,800 to all the way down to 4,222. And take that even more of an extreme, we were at 4,600 on the 18th, and the 18th was Tuesday of last week. So we've sold off almost 600 points very quickly. And with that, if you listen to the news right now, a lot of people are stunned that we rallied this much today. Especially when we gap down all the way down here. How could we go all the way down here and all the way up? Well, this is such an obvious magnet. The first magnet was the December low. And let me back up for a second. We had a wedge top. Everybody knew that we're in a trading range. Everybody knew we were going to get to the December low and then the October 2021 lows at some point this year. What we did know is the path. What we did not know is the path. And you look at this bar over here after the Fed report on a couple Wednesdays ago, strong bear bar, and the odds are we were going to get a second leg down. But what we did not know is this a second leg trap, and we have to go to a new high before we turn down. And we got a doji, and then a bear bar, and then a big bull bar. Let me do this. And then a big bull bar. And traders were hopeful that we would rally and get a very deep pullback and possibly get a new all-time high. However, with this much overlap here and over here and over here, even if we got to a new high, the odds are we were going to find sellers. So big bull bar and then a pause. And if you think about the math here, traders could sell, and maybe they sell, pick a place. I cannot remember the number, but it's somewhere. Let me just do the math real quick. Somewhere was it didn't do it. There we go. So 47.30 is a 66% pullback of, sorry about that, 66% pullback of this sell-off. And that gives you a 2-to-1 risk reward. So if you sell here, put a stop up here, bet on a new low, you've got a 2-to-1 risk reward if you hold on to the trade. And that's actually what happened. And, at some point over here, we just start to collapse. We tested all the moving averages, 50-day. Well, we've already tested the 50-day, but the 100-day, 150, 200-day. And, 4 consecutive bear days. I thought on the open that I thought we would have a bull close. And the reason I thought we would have a bull close is, just look back on all the days. Here was the pandemic sell-off. 1, 2, 3, 4 consecutive bear bars. But they weren't really as strong as what we had recently in the past couple of days. And we got a bull bar, and then a rally, then another crash. Here. Here's an example where we did have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 consecutive bear bars. That's very unusual. But it's also See if I can kind of get back to it. It's a pretty deep pullback. So that's part of the reason why I thought we were going to find, I thought the Bears were going to be disappointed today. I didn't know we were going to close on the high, but we ended up closing on the high. So let me go to the 5-minute chart. So let me just get rid of all this. This red line, by the way, is the October lows. You can see, I'll just make it blue, make it seem more important. So let's see here. So Thursday, huge sell-off. And Friday, we ended up getting follow-through. And today we gapped down. And this gap's about 87 to 25, about 40-point gap. So first bar of the day, doji bar. Probably buyers below and sellers above. Probably will have to get back up to the moving average. Typically when this happens, you'll see price retrace back to the moving average, and less likely you will have a strong bear trend or a strong bull trend. But the problem is you don't know. We may have to test something first. So, if you're aware of the context, you've got the October lows at 42.60, and we're only 40 points away, and that seems like a really far ways away, but it's really not when the range is this big. So big bull bar, bears. Well, the bulls see a failed breakout of the lows of Friday and a trend from the open rally. The bears see a bear breakout, pullback, and a low one short, and outside down. Bears also, you can call it some sort of double top. Sold off, rallied, sold off, rallied. I wouldn't look at it like that. Big bear bar, are we always in long or always in short? We're probably pretty close to neutral. It's, traders can sell the close, stop up here betting that we test down to the October lows and we get a trend from the open. Other traders will sit on the sidelines, and then we get a bear bar, follow through bar, and it looks like it's going to reverse. You're thinking, here's a low, we reversed up, sell off. Well, we're probably going to reverse up, and we might. It's you can call it a second entry buy, second failed breakout of the prior day's lows. But again, the problem is 3 consecutive bear bars, and we may get trapped traders here. Bulls bought this low, scaled and lower. It'll be interesting to see if they can get out, and they did. But now we're getting a low one short and 4 consecutive bear bars, and only 1 bull bar in the entire day, and then we get another big bear bar. So we're 35 minutes into the day, and we've gotten 6 bear bars out of 7, and another big bear bar, and then we're there. And the problem with this sell-off is it's really hard to sell. Here, tight trading range, bad signal bar, probably buyers below. I don't know if I want to buy here. Bad follow through, not great selling, and hard to sell. Weak stop entry buy, 3 consecutive bear bars, but it's not closing on its low. Probably buyers below. Outside down, but again, forcing you to sell far below. So, a lot of traders, they'll sell, put a stop up here, and, maybe they've got a 40% chance, and it might be closer to 50-50 that they can get 2 times their actual risk. So if they sold this bar, there's their actual risk. So maybe they put a stop up here. It's 1 times their risk, and 2 times the risk is about right there. But most traders would hold for a swing. Now we're getting a parabolic wedge. First push, second push, third push. It's a reasonable stop entry buy. You're at an obvious target. Probably a minor reversal up. So a lot of traders, they do buy, they'll be quick to get out, like a second entry short. And trigger going outside down, but stop didn't get hit. So now we have a micro double bottom. More bulls probably buy above this high or this high. Weak follow through. So it's low 2 short, but this low 1 didn't trigger. So some traders will see it as low 1, and we're starting to rally. And what's important to realize here, this is actually a micro double top. So we went up, pulled back, up, pulled back. So it's second entry short, micro double top, wedge, 1, pull back 2, pull back 3, and a micro double top, and a high from right here. So one thing you have to remember is if you're long, where's your stop? Is it here? Is it here? Here? And you have to ask yourself if your stop's far away, what's the probability that you're going to make money? And sorry, I had to look at something. Let me back up with that, because this is an important concept to think about. So at this point, where's your stop if you're short? It's either here or up here. And you have to ask yourself, what's the probability if you sell this low, stop up here, what's the probability you're going to get all the way down there? Well, let's say it's 60%. At some point, your risk grows to here. What's the probability price will go all the way down here before it gets to here? Well, that's probably not 60%. You've got the October lows. It's an obvious magnet. And while we may go below the October low, we may not go that far below it. So it's probably closer to 50-50. And therefore, you probably need 1.5 times your risk, which could put you all the way down here as your profit target. So other traders will look at that and they'll say, I don't want to risk that much. I'll tighten my stop to maybe here. And, they'll sell above, stop up here, and maybe go for 2 times the risk. A lot of traders will say, gee, this is parabolic. Usually on the open, you always get a minor reversal. Sometimes it pulls back very deep. I'm just going to get out. Other bulls look at this and say, gee, this is really good risk reward. Maybe a 40% chance. I buy above it, stop below. I catch the low of the day, and we get a strong rally. And we rallied. Well, at some point, the bulls have to look at this and say, dang, my stop's far away. So if my stop's here and you buy here, and when I say you buy, I mean you're long here. It doesn't matter if you bought here, this close, this high, this close, above this bar. At some point, your risk is from here to somewhere. Let's just say down here. And a lot of traders would not be confident that we're going to get a measured move up based on this. It's a tight trading range. It's a trading range. And we've got to break above the moving average. We've got to break above the open of the day. We've got the high of the day. Strong trend. A lot of traders are questioning this might be a sell vacuum. You've also got this high. So all of this is a possible double top. And if that's the case, a lot of traders will be really quick to get out because they understand the math's not that great for using a really wide stop. It's the same concept of being short down here. If you're short here, where's your stop? Up here? It's kind of like, and this is a really important concept to really understand, because it's really the basis of trading. If I sell here, where's my stop? Is it here? Well, what's the probability price goes from this high to this high? It's probably 60%. Therefore, I don't want to have a stop here. If I have a stop here, I just need to get out above the bar. So I can use a wider stop, and that'll increase my probability, but it also increases my risk. On one hand, I could use a stop all the way up here, 45.80, and that puts my 1-to-1 all the way down to here. And what's the probability of that? So you adjust probabilities with risk reward. You increase the risk, lower the reward. You lessen the risk, increase the reward. And a bull buying here has probably at least a 40% chance of getting a couple legs up. So anyways, more to talk on that later, but that's why a lot of traders will get out below a bull bar, and it's certainly 1, 2, 3 points below a bull bar, because they understand the math's bad. So big bear bar, bears, hoping for a channel, something like that. And they're hoping to continue to lower highs and lower lows. And bears see a double top here to here. They know that most double tops do not go straight down. They usually look bad. So they understand that if they sell below this bar, sell this close, stop up here, that we could easily get a really deep pullback and still stay above this lower high or this lower high. Now we have a second entry short, so more bears will probably sell below, maybe stop up here or here or here, and they're betting on the bear breakout measured move, and they have probably a 40% chance in general. Now I think the October low makes that a little more interesting math, but it's a reasonable trade. Certainly, I would get out of the longs if I was long. So 4 consecutive bear bars, probably going to have to at least, go one tick below the lows, the October lows. It's just such an obvious magnet. Bulls want a double bottom, but 4 consecutive bear bars probably going at least a little bit lower. Second entry buy. So what do the bears do? Did the bears get out here? Probably. You have a low, you have a higher low, you have a high, lower high. It's a triangle. And all a triangle is it's a trading range that's converging together. So you have two trends, lower highs and higher lows, meeting each other, and one's got to break out. So now we have a low too short. If you are long, probably reasonable to get out below that. And we finally tested the October low. And now we're below it. And now we get a big bear bar. So is this going to be the start of a strong trend? And, is this going to be a spike and channel down? Maybe, but probably not. Big bear bar, but possible double top, measured move down. However, best looking bear bar, 2 legs down, what's likely to be a trading range. While this is a tight channel and probably strong enough for a second leg down, you're probably going to find buyers. And there you go. So it's the best looking bear bar. You're also trying to break far below the October low. So again, let me back up here. I'm going to have to do it like this to kind of show a point. A lot of traders they'll buy this low, they'll buy the October low, and they'll buy 5-10 points lower, get out of break even. And over here, you have other traders who will, same thing. We're getting 5 or 10 points over here away from the October low. They're going to buy, and even though it pulled back a little bit, they may buy more lower. They may just use a wide stop and say, I'll have to look. I think that's the low of the day, but I'll have to double check. They may use a wide stop and just say, here's my actual risk. If I bought anywhere over here, I had to put a stop down here. 1 times my risk is that. I was willing to use a stop all the way down here, so I think it's 60%. And they will take profits. Again, I wouldn't recommend doing that, especially when the range is really big, because the risk can be far more than you think. So let me back up here. So now I have a wedge bottom. Obvious stop entry buy. Even though it failed, a lot of traders will think it's a trading range day, so they'll buy more lower, confident that we can get back out at that original entry. And they're also confident that as strong as this sell-off is, it's a vacuum test to a very important sport, and there's going to be buyers down here. This is a very important magnet on the weekly and monthly chart, and traders know that. So let me just kind of back up to where I am. Okay, so wedge bottom, and I'll go over always in a minute, but a lot of traders will get out somewhere down here. Big bull bars, 3 consecutive bull bars breaking back above the moving average, breaking above this high, so it's probably no longer a bear trend, probably either some sort of bull trend or trading range. The bears, again, they want some sort of double top. They had a double top here. They pretty much got to it, depending on how you draw it. So I'll consider that being a successful test. 3 consecutive bull bars, probably always in long. First down is probably going to fail. Stop below here or here. Outside up, and bulls got the breakout and follow through. So stop's probably down here. 4 consecutive bull bars, probably going higher. Multitask here. Probably going a little bit higher. Odds are we'll probably test back to the open of the day. I think we're going to close above the open due to the daily chart. Big bear bar, but again, it's a wedge, 1, 2, 3, call it a parabolic wedge, doesn't matter. this is a strong enough, well, for one, this is a wedge bottom, 3 pushes down, 1, 2, 3, so I expect 10 bars, 2 legs up. This is probably just 1 leg in a tight channel, so probably get a second leg up. And we got that second leg up. And now we're back to the open of the day, broke above it, turned down, and do that. And now we're going down. So why did this happen? It's a high 1 buy, it's at resistance, high of the day, open of the day. High 1 buy, big risk, probably stop down here, and it's probably going to fail. But bears will also see a micro double top. So rally, pull back, rally again. When it falls below that, it's micro double top. 3 consecutive bear bars, probably strong enough that we'll at least get a second leg down. You have to also remember we have 2 obvious magnets, October lows and the open of the day. We're probably going to kind of oscillate in between them. Pause, but probably going a little bit lower. And for a second leg down, we tried to reach the October lows and failed. So if you're short, a lot of bulls will buy above, stop below. 3 consecutive bull bars, always in long. And I believe it rallied at the close. So you look back at the day, and before you know it, you've got closed above the open. So always in on a day like today, the first thing, number one, you have to be aware of the risk. The day is huge, and it's very important to realize that, on this really small bar here, this is 11 points. So if you're trading 1 micro, that's $55 risk. If you're selling here, this close is 35.25. This high is 86 even. So that's all. That's 50 points. That's $250 a contract right here. So people have to be very aware of that. For always in, probably always in short on the open. If you really want to and you're aggressive, you can sell the close, stop up here, sell this close, stop above, sell this close, stop above. I would not. You maybe sell above, stop above here, sell below, stop above here. Always in bulls, probably get out. Aggressive bears, they can buy. Others will wait. And if they did buy, they probably just keep the stop below. Bulls, as it turns up, others may buy above this bar. And, what do you do here? Well, some traders will get out a couple points below. Others get out below this bear bar. Done trigger. And then you get a second entry short. Definitely get out below that bar. And, do you get out here? That's a tough one. It's a major trend reversal, bear trend line break, couple legs down, second entry buy. Some always in bulls. It just depends. This is it's trading range. You're getting a triangle. So higher lows, lower high. So you'll have plenty of traders who will buy above, stop down here, stop down here. You have other traders who will get out of shorts and then they'll sell a second entry short. So it's pretty neutral. And you could have sold in here, but I think it's aggressive. I'd rather look for longs, especially in this area of support. So do you buy above it? You certainly can, but after 3 consecutive bear bars, probably pretty difficult to do, but it's a reasonable buy. And if you buy and you get stopped out, you look to buy again. And obviously you get stopped out. So what do? Maybe you buy again here, stop down here. And there's the rally. Other traders, by the way, if they can trade 2 contracts, maybe they traded 1 contract and they will use a wide stop, something like this, and they look to buy more, who knows, maybe this low or several points below. Or other traders just buy 1 contract, get stopped out, then they buy 2 contracts, stop below, or they trade a half size position, get stopped out, trade a full size. So always in long on this close. Probably bulls will buy, stop down here, maybe here. And they'll probably tighten the stop up here. Bear bar, but no reason to get out. And at this point, probably tighten the stop. And, do you get out here? It's a wedge, 1, 2, 3. I think it's okay to get out. But, again, it's 50% pullback, so you can keep your stop down here. And in that case, what do you do here? Do you get out? Probably. So if you didn't get out below this bar or this bar, you definitely get out on the close of this bar. And aggressive bears will sell. I think it's hard to reverse back and forth though. Odds are you'll get a second leg down and outside up. So a lot of bulls will buy again right here. And if you notice, it went, arguably always in short here. A lot of bulls will get out and they have the chance to buy again right here. So that's why I think it's difficult to flip-flop back and forth. If you think the overall trend direction's up, it's better just to get out and just wait a few bars and a few legs and miss the sell-off. Because too many times you'll get out of a long and you'll reverse to short and you'll be disappointed with this. So for one, you'll be disappointed because you lost profit up here. So you'll short, and then you'll be disappointed because you lost a little money shorting, and now it's second entry buy. It's a higher low double bottom, or higher low major trend reversal in the form of a double bottom. So you can call it a head and shoulders bottom, left shoulder, head, right shoulder, and you'll end up missing this buy, which was way better than selling here. The sell-off was limited, and it's not a good sell because the risk is high, stops up here, and the profit potential is probably small. So a lot of bulls, always in bears, get out above. Bulls buy, probably stop below, and we rallied pretty strongly into the close. You could have gotten several times your risk, and that was pretty much the rest of the day. Hope this video helps.